Hello everyone, and welcome back to another tax talk. Today, we're diving into a topic of capital and non-capital losses. Let's first look into what a capital loss is. When you sell a capital property for a loss, that loss is called capital loss. Some examples of capital properties are big investments, like purchase of a building or a real estate property, stocks, mutual funds, bonds, and even purchase of a land for investment. For instance, you bought shares for $10,000 and sold them later for $7,000. The loss of $3,000 is called capital loss. Now what do we do with this capital loss? Let's say, if you have a profit by selling another capital property, say, you sold some share for profit, and have to pay tax on that profit. In this case, you can use the capital loss to reduce the profit, and that way, you don't have to pay any taxes. Now here's the catch. The capital loss can only be used against capital gain. Now, what's capital gain? Yes, you guessed it right. It's the profit you made on selling the capital property. Let's use same example. You bought shares for $10,000 and sold them for $15,000. The profit of $5,000 is called capital gain. Now, you have to pay tax only on 50% of capital gain. So in our case, the tax will be calculated on $2,500, that is, half of $5,000. What happens to remaining half? Well, good news, there's no tax on it. Now let's go back to the capital losses. If you have a profit, then you can use capital losses to bring the profit down. But what if you don't have any profit? In that case, you can keep the capital loss aside in a bucket and use it as you need it. There is a bucket where you can keep track of all the capital losses on CRA website. Now, for how long can you keep the capital losses in this bucket? Good news is, for unlimited time, there is no expiry on it, so you can use it anytime in future to bring your taxes down whenever you have capital profit. Bonus is, you can also take the capital loss back in time for past 3 years. Say, you sold some property last year for a profit and had to pay tax on it. Last year you did not have any capital loss to bring the profit to zero, but this year, you sold some shares for a loss, so you can take this loss to last year tax return and get back the taxes you paid. Let's use the same example. You had a profit of $5,000 last year and paid tax on 50% of profit, that is on $2,500. To keep the example simple, you paid $662 tax at 26.5% tax rate. This year you have a loss. Let's say you have same loss of $5,000. You can take it back to last year and get the $662 back that was paid in taxes. Now remember, how the tax on capital gain works is, there are 2 buckets. Tax is only calculated on 50% of capital gain. The other tax-free amount of 50% goes into capital dividend account. This amount that goes into capital dividend account bucket is not taxed. I've made a separate video to explain capital dividend account. Feel free to check it out. On the corporate tax return, you can track the capital losses in a form called Schedule 4, and on CRA website, you can check the balance on capital loss when you log in online. Now, let's switch gears to non-capital losses. We already spoke about property and investment for capital losses. Now, anything that is not a property or investment is non-capital, like business income and loss. If your business has more expense than income, then that means it's having losses, and this type of loss is called non-capital loss. Same as capital losses, the non-capital loss can be taken back 3 years to use against income and get the tax back that you paid in last 3 years. However, there is a limit for future years. The non-capital loss expires after 20 years. So you need to use it before it's gone. Non-capital loss comes from running your business or property income. They can be used to bring down any kind of income, like employment, business, rental, etc. However, capital losses can only be used to bring down profit from sale of capital properties. The CRA tracks them year over year, and you'll see your available loss balance on your notice of assessment. Here is a summary of capital loss versus non-capital loss that states the source of income that can be considered as capital or non-capital income, the deductibility amount, and what type of income can be offset against capital and non-capital loss. Their carryback period, that is, for how many years it can be carried back, and their carryforward period, that is, for how many years it can be used in the future. Hope you have a better understanding of what capital and non-capital losses are and how they work. That's all for this video. If you have any questions, comments, or would like me to explain any other tax topic in detail, please feel free to drop a comment below. If you found this video helpful, please give it a like, hit that subscribe button, and share it with your friends who could really use some help. Good luck. Bye for now.